Here's a little bit of history. Back in the day before the internet, Warren Buffett would scour over thousands of pages of what were called Moody's manuals to find his stock picks. These were big books that were published containing the information and financial history of all the public companies in America. 20,000 pages, and he'd go through them twice. Just to give you an idea of how much time he spent researching and searching for companies, when he got married, he took his Moody's manuals with him on his honeymoon. So yeah, he literally familiarized himself with every single public company in America. Literally. First, he would go through and he'd make notes separately of the ones that he thought were interesting. Then he'd go through that list and he would do a little bit more thorough research into each of those companies to narrow his list down even further. And then he'd wind up concentrating his money into just the ones that he thought were the best bets. The internet has made this process so much easier. So let's hop on the computer and I'm gonna give you a little tour of the stock screener that I use. Okay, so here we are in the stock screener that I use, Guru Focus. And I'll put a link in the description as well for you. So first thing I'm going to do quickly is just going to put industries to all because I want to show you how many stocks there are that we're going to be narrowing down from. So as you can see at the bottom here, there's 13,000 stocks, 13,000 companies. And right now we're looking within the US and Canadian stocks. So there's 13,000 for us to start with, and we're gonna narrow down from here. I'm gonna hop over to the profitability tab, and I'm gonna set this to 10. Now this is the number of profitable years over the past 10 years. So we're gonna say that 10 out of the past 10 years have been profitable. And so you can see that that instantly has narrowed this down to just under 2,500 stocks just from that one parameter alone. And then while we're on this profitability page, let's say that gross margins, we don't want declining gross margins. So we want the gross margins to either just be maintaining or increasing. So we're gonna put 0% here. So we want the gross margins growth rate to at least be staying level. We don't want it to be declining because the declining gross margins would be an indication that a company is maybe losing its competitive advantage. And then staying within the gross margin section, I'm gonna change this to 30, and same for the 10-year median. I'm gonna put 30 here, and companies that have higher than 30% gross margins, that's probably a good indication that they're a company that has a decent competitive advantage. Now at the same time, while we do this, we're gonna add in a bunch of parameters here, but I want you to keep in mind that it's good to not go too strict in your screening because you might weed out a company that you would otherwise would have found that would have been a totally overlooked company, but it was overlooked by yourself as well because you made your screening parameters just too strict. But we're just gonna play around with it for a minute. I'm gonna throw in some different parameters just so you can see what it looks like. So on this page as well, let's say that the free cash flow margin is greater than 0 as well. We're gonna narrow it down again. So we have 500 companies roughly. Remember, we're narrowing down, I think originally it was 13,000 companies we started with. We've just added in a couple parameters. We've narrowed it down to almost 500. And then let's go over to the growth tab and let's just say that we're looking for companies that are growing. So what you could do is you could add 0% into these different categories here for total revenue and revenue growth per share. So we want to see revenue that has been consistently growing. And now we've narrowed it down to 193 companies. So let's keep narrowing down further, and then let's go back to the fundamentals tab. And let's say this time we want to see return on tangible assets higher than 10%. For like current and the 10-year median. And now we've narrowed it down to 106 companies. I'll show you some of the other ones, but maybe we'll stop there for now. But we have the valuation ratios. So of course the PE ratio, price to book ratio. So maybe we want to say the PE ratio is between 0 and 20. Although I don't personally use the PE ratio all too much, but adding in that PE ratio parameter has narrowed it down to 25. And then if we were to sort by the PE ratio, okay, so from there we might start to look at some of these companies that the screener has turned up. So let's just choose one of these. Let's choose Clorox. And if we hop into here, we can get at a glance statistics and information. So we can see that their revenue and net income, this is cash and debt. We have cash flows right here, operating income, free cash flow, net income, and cash flow for dividends. You can sort of see a whole bunch of things at a glance. At the bottom, when you scroll down, you can see a description, and then you can also go into the 30-year financials. And from here, you can see at a glance historical information. If you wanted to click on a particular one to see it as a graph, you can see what the revenue per share has been doing over time, for example. There's actually a lot more that I could show you in this website, Guru Focus. They also have a bunch of pre-made screeners. They've got a Buffett Munger screener. They've got a Ben Graham net screener. Peter Lynch screener. So they've got a bunch of like pre-made screeners. And then of course, the one we looked at together was just the all-in-one screener where you set up your own parameters. So yeah, there's so much I could actually show you. So if you wanted to see a full tutorial on using Guru Focus, let me know in the comments if that's something you'd be interested in. But for now, I'm gonna hop off the computer, and what I wanna tell you about next is the different financial metrics and financial ratios that Warren Buffett would say indicates that a company may have a durable competitive advantage. So now I'm gonna close down the computer so we can get right into it. Now I'm gonna tell you about 4 financial metrics that can help you to find potentially great companies to buy ownership in. First though, I wanna make the point again that in general, you're not gonna wanna make your screening filters too restrictive. It's definitely better to have a larger list of companies to look through than it is to screen by too many parameters and filter away and miss out on finding a potentially great company because your screening filtered it away and out of sight. So now that we've got that out of the way, let's just get right into it. The first is gross profit margins. We already touched on this a little bit while we were looking at the screener. Gross profits are calculated by taking the total revenue and subtracting the cost of goods sold. Gross margins are definitely a good indicator that a company may have a durable competitive advantage. For example, Coca-Cola's gross margins are consistently above 60%, whereas a company like General Motors has margins hovering around 7% to 12%, and even negative gross margins in tough years. The other thing with gross margins that you'll want to look at is whether the gross margins have been consistently good over time. It's good to see gross margins that are being maintained or even possibly improving. If you see gross margins have been continually shrinking, it's probably a sign that the company is losing its competitive advantage. The next one I'm going to tell you about might surprise you because it goes against the general consensus of what you should look for. I'm talking about the current ratio. The current ratio is the current assets divided by the current liabilities. Current assets include cash and short-term investments, inventory, and accounts receivable. And current liabilities include liabilities that need to be paid in the current year. So if a company had $1 per share in current assets and $1 per share in current liabilities, it would have a current ratio of 1. If instead the company had just 80 cents per share in current assets, but still $1 per share in current liabilities, then that would mean the current ratio is 0.80. The general belief about the current ratio is that it's best to screen for companies that have a current ratio above at least 1. And the idea behind that belief is that if a company has a current ratio below 1, then it means the company won't be able to meet its current obligations without needing to take on more long-term debt, and the thoughts are that this is a bad sign of a company's financial health. However, if you were to filter out all the companies with a current ratio below 1, then you would surely be missing out on finding some of those companies that have that elusive, long-term, durable competitive advantage that we're looking for. Coca-Cola, for example, again, will occasionally maintain a current ratio below 1. And there are plenty of other great companies with strong competitive advantages that will dip below the current ratio of 1 or even maintain a below 1 current ratio. The reason is that companies with long-term competitive advantages make so much money that their earnings are more than enough to cover their current liabilities, so it's a non-issue for them. And if all of a sudden they needed money in the short term, it would be very easy for them to access money and borrow it at very low rates. So the bottom line with this one is that the current ratio will not help you one way or the other when it comes to finding companies with durable competitive advantages. But screening out companies with a current ratio of less than 1 could certainly cause you to filter away a potentially great company. So in other words, I wouldn't bother using the current ratio in your screening. Next, I want to introduce you to an alternative to the price to earnings ratio. No, it's not a metric that will help you identify a company with a durable competitive advantage. However, it has its advantages over the popular price to earnings ratio, which makes it worth mentioning in a video like this one. It's called the enterprise value to free cash flow, or EV to free cash flow for short. It's very similar to the PE ratio in that it has the same purpose of being a valuation metric, but in my opinion, it's a much better one. So in this financial metric, enterprise value is used instead of price. And it's better than price because it represents the true cost much better than price by incorporating debt and cash. Think of it like this. If you were to buy an entire company for $10 million, but that company had $50 million of debt that you'd be taking on with it, well, your real cost would be $60 million. That's the enterprise value. The $10 million price plus the $50 million of debt you've just inherited. Likewise, if you purchased a company for $10 million and that company had cash in the bank of $2 million and no debt, it would be as if you bought the company for $8 million. That's the enterprise value, right? That's the $10 million price minus the $2 million of cash you got for free that it came with. So that's why I like enterprise value much better than price. And then for the bottom half of that ratio, we have free cash flow. And I like this much better than earnings because the problem with reported earnings at the bottom of the income statement is like how Charlie Munger says. He says there's two kinds of businesses. The first earns 12% and you can take it out at the end of the year. The second earns 12%, but the excess cash must be reinvested. There's never any cash. It reminds me of the guy who looks at his equipment and says, "There's all my profit." We hate that kind of business. Okay, so using free cash flow as an alternative to reported earnings may help you to avoid finding that second type of business that Charlie Munger is referring to. And also, free cash flow is very similar to what Warren Buffett calls owner earnings. Similar to how a low price to earnings ratio means cheaper, it works the same way with EV to free cash flow. Lower means cheaper. So this might be a metric to sort your findings when you do your screening. By the way, if you're enjoying this video, you're also going to enjoy this video I made about the PE ratio specifically, so check that one out right here. One small thing to add in here is something to watch out for with the free cash flow is that some companies can show very rocky and inconsistent free cash flow. So if you find a company that has a large spike in free cash flow in the most recent year, I'd take that with a grain of salt. What you want to do when you're looking for great companies is look for companies that have very consistent and consistently growing free cash flow. In the end, it's going to be very difficult to value a company anyways if it's not very consistent. So here's an example of free cash flow when it's consistent, and here's an example of what it looks like when it's not consistent. Okay, so finally, I've saved the one that's most interesting to me for last, and let me introduce it with another Charlie Munger quote. He says, "Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result." This is huge, and really, it's the cornerstone of Warren Buffett's and Charlie Munger's investment philosophy. This means that high returns on capital is definitely a metric to screen for, and it should go without saying that a business showing consistently high returns on capital is a strong sign that it's a company with a durable competitive advantage. There's a bunch of returns on metrics that are popular: return on equity, return on capital, return on invested capital, return on assets, return on tangible assets. What you need to know is that the higher the better for all of these. A quick thing to add in there is that sometimes companies with durable competitive advantages don't actually have shareholders' equity. So if you were to screen using the return on equity metric, you might actually screen out some potentially good companies. I like to use return on invested capital. When you see high returns on invested capital, it also tells you that management really understands capital allocation and does a good job at it. And it's definitely something important to desire in a company that you're going to buy stock of. And you'll soon discover that it's definitely not by default that a business's management does understand capital allocation and is actually focused on increasing per share intrinsic value as their main priority, unfortunately. Great CEOs are actually kind of rare to come by. I could seriously go on and on because I've really only just scratched the surface here, but in a future video, I'll talk about how to dive in and do more thorough research into a potential stock that you've found, how to review annual and quarterly reports, and what to look for. But hopefully you've got some good info from this one, and if you have, give this video a thumbs up. I don't really know of any other way of finding stocks other than using a stock screener, so you might want to try it out for yourself. I put the link in the description. It is the screener that I personally use, and it's the one that I've found has the most features that I've tried. It also lets you make your own custom metrics, which I mostly use exclusively now. And the other thing I like about Guru Focus is that it lets you screen many different countries and exchanges, not just America and Canada, and going fishing in those less crowded ponds is another great way to find overlooked stocks. Also, if you want to keep learning, I just created this playlist right here for you, so click here to get access to it. And besides that, I just want to remind you that I'm not a financial advisor. I'm just a guy on YouTube, so always do your own research, your own critical thinking, and make your own decisions before you take any action on anything that I put out there anywhere. I'll see you over in this playlist.